Hello, thanks for joining us today. Today we're going to be talking about Treasury bonds and a unique new strategy we put into the portfolios over the last month or so, which we think could really add value and additional yield without taking any credit or default risk, because these are still Treasury bonds. So we'll dive in a little more. And what exactly we'll go over today is looking at first the current Treasury rate environment, what the different yields are available on different types of Treasury bonds. Look at the two different types of risks associated with Treasury bonds. That one would be the risk that most investors are familiar with. That's if you buy a bond, rates go up, price goes down. It's called duration risk, and vice versa. And the other is reinvestment risk, which is less well known, but we'll get into that. Third, we'll actually go into the ETF or the strategy that we have purchased for most investors, called TLTW is the ticker. And that's a combination of owning bonds and then selling monthly call options on those bonds. We'll look at recent performance of the strategy, and then we'll also look how it relates to interest rates through time. And then lastly, we'll look at some conclusions from this strategy, and then when we would possibly look to sell it sometime down the road. So first thing we'll look at is where we are now in terms of Treasury yields across what they call the curve. So this graph represents, on the bottom left, 2.5%, on the top left, 5.5% in terms of yield. And then on the bottom are the different maturities. So the first bar on the left is 1 month. So if you buy a Treasury bond that has a 1 month maturity, you will get the equivalent of 4.3% in that 1 month, but annualized. So 1/12 of the 4.3%, 2 months, 3 months, so on and so forth, all the way out to 30 years. And then as you can see here, the highest yields are in about the 2 month to 1 year period, above or near 5%. And then somewhat rarely, the yields actually go down from there as you go further out. So if you buy a 2, a 3, a 7, or a 10 year, you actually get much lower yields going out that far. And that's where we're going to get into this weird trade-off now we have with Treasury bonds, where, if you buy a short-term Treasury, your principal is protected completely. You will not see any movement in price, but you're only locking in those really high yields for a short period of time. In 6 months, if yields are 2% lower, then you will have much lower returns going forward from there. Where if you buy a 10-year, or a 20, or a 30, then you're locking in those types of yields for a very long time. So very little reinvestment risk, but more duration risk. So that's where we are now. We have many clients invested in this part of the curve to be ultra safe, liquid, and earning, good upper 4s to about 5% in yield. And then our new strategy is actually out here in very long-term treasuries, and we'll talk about that in a second. Before we get into that, though, this is also important, and this is what the market thinks of the future Fed rate. So the Fed sets short-term rates. They have no direct impact on longer-term interest rates, but they do control short-term rates, or what you get on cash. So right now, the Fed funds rate is somewhere between 4.75 and 5%, and they probably will raise it one more time, we think, of 0.25% in May, so it might go up a little bit more. But what this chart is saying is the market overall thinks over the next year, especially 2 years, rates will come down a lot on cash. So right now, the forecast stated over here is about a 2% drop in short-term rates or cash rates over the next 1.5 years or 2 years. So this is saying, yep, right now on cash, you're getting about upper 4s to about 5%, but in 2 years' time, that might be down as low as 3 or even a little bit under 3%. So, rates are higher now, we want to take advantage of it. And again, this is the type of, 2 types of risks with bonds. Again, this on the left is more well known. So this is bond duration risk. And this is the simple fact where if you buy a bond now, it matures in 10 years, it yields 3%. If all of a sudden rates go up and now everybody could get bonds that are yielding 5, the value of your 3% is less, obviously, because nobody wants 3% and you get 5%. And that's what this little pivot shows here. Interest rates go up, the bond value will come down. Now, if you hold to maturity of the bond, and in the case of treasuries, there's no default risk. So as long as you hold to maturity, you will get your principal back, but in the meantime, it can be very volatile. So for instance, if you held 10-year treasuries last year, those were down 15–20% last year in value. Again, if you hold for the full 10 years, you'll get that back, but it'll be an uncomfortable period. So that's, most investors are cognizant of this, but on this side, it's not as obvious to many, but it's still an important piece. So this is reinvestment risk. So here, let's say you invest in a 1-year maturity bond with 1 year to go, and let's say it pays 5%. So for that 1-year period, you locked in 5%. Principal's very safe. It'll hardly move no matter what interest rates do because it's so short of maturity. And you'll get your 5% for the 1 year. Now the risk there is in 1 year from now, what if rates are 2%? Then you're sort of stuck. Instead of getting 5%, you're reinvesting. The risk is down to 2%. So that's the risk you run with very short-term bonds, is that rates go down, and now you're stuck reinvesting at much lower rates. The bottom figure, which sort of ends behind me, so you have to bear with that, but if, let's say this is a 5-year bond, that was also paying 5%. So here, you've locked in 5% for 5 years with no reinvestment risk for those 5 years. So this guy here, or gal, will be reinvesting 1 year 5%. After that, if rates go down, they'll be at 2%. Here, that same investor gets 5% for 5 years, no reinvestment risk for that period, although there's higher duration risk. So you have to think of both of these things when you go into bonds, and obviously we think about that, investing on behalf of our clients. Now, with that in mind, this is the new strategy that we have in almost all client portfolios now. And it's a cheap, very cheap, low-fee ETF called TLTW. And this explains what this does and why we like it. So it is an ETF, exchange-traded fund, that holds very long-term bonds. So this holds bonds that mature in 20 or 30 years, very long-term bonds. This is liquid. We could sell and buy any day we wish. So the vehicle itself is very liquid. Sell any day, anytime we want. The bonds that are within it, though, are very long-term, 20 to 30 years. Then, off just the normal interest of these bonds, we're getting right now about 3.7, 3.8% in yield from just holding the bonds. So that's cash. That's this cash up here on the top right coming to the trap pagan investor. But what is unique about this is at the same time, we are selling call options on a monthly basis on the bonds we own. So not to get into technicals here, but this is basically just a vehicle that gives the call option buyer on the far left the right to buy our bonds from us if certain prices are hit. So we're selling them, these buyers, the option to buy our bonds from us. And in exchange for that option, the buyer gives us cash back. So we get cash for selling that option. Right now, these are very variable. They go up and down a lot, but right now we are getting a good amount of interest. So on an annualized basis from continually selling these options, we're getting about a 7 to 15% yield just from selling the options. So again, that's went from the option call buyer through the vehicle, TLTW, and that's passed to investors in this ETF as well. So right now, as it stands, and again, this will go up and down through time, but right now we're getting about, low to mid-teens yield from a combination of the actual bond interest off the straight bonds and the option premiums that are coming in cash on a treasury bond portfolio. So we're getting, low to mid-teen return, no credit, no default risk because they are treasury bonds. And we also think this is a good hedge in case there is a slowdown or a recession. If we get a slowdown or a recession, usually bonds either stay where they are or even go down, and that could add additional returns to this because the value of the bonds would then go up. So I like this as a both offensive and a defensive position in the portfolios right now. And again, all these are as of mid-April 2023. So over time, these things will change, both the option amount and the interest amount. But right now, we do like the math on these things. And in a general sense, that's how these work. Most clients have about 3 to 4% of their total portfolios in this vehicle at this time. And now this is, there's a lot of things in the chart, but it is important. So I'll walk through here. So this is a chart just for 23, just the past 3.5 months or so. This dark line here represents the yield on long-term treasuries. So as you see here, this was 4%, 3.7%, 3.3%, and you see the yield that long-term treasuries went through so far this year. So it started the year at about 3.8 or a little over, went down to 3.4, back up to just under 4, then back down, and now we sit at about 3.7, 3.8%. It actually went up since I made this chart a little bit. Now, what I want you to notice is these other lines, the thinner lines, the blue and the red, one is the red line is TLTW, the strategy or the fund that we just talked about. The thin purple line is TLT, which is just owning the bonds without the Treasury selling the options on it. So the thin purple line is just owning long-term bonds, no options. The red line is TLTW, the strategy we just went over, which is owning the bonds and selling the options. What you'll notice, both of those vehicles will go down if interest rates go up. So this is interest rates going up, this thick line in the middle of the chart, and because of that, both our strategy, TLTW, and just bonds overall will come down in value. But what these red circles indicate, in any time that interest rates go up and the value comes down, the TLTW does perform better. So there is some protection even against rising interest rates versus just holding the bonds. And that's because we're continually bringing money in from selling the calls. So it offers protection there. And the other thing I want you to notice is year to date, short period of time, but so far, because we're yielding more, getting more money by selling the call options, TLTW has returned about 10% or so, while just owning the bonds themselves have returned about 7% this year. So it does protect you, if interest rates go up, prices come down to an extent versus just holding the bonds. And it does have the potential to earn more because we're earning the option yield as well. Now, there will be times that we would look to sell or trim this, not yet or not now. Obviously, we just bought them, but there can be instances where we would look to get out. So this is, looking at conclusions and when we might do that in the future. So we think it's a good way, to own long-term Treasury bonds. It's much better, in our opinion, than owning straight Treasuries. You get better yield and somewhat less interest rate risk than just holding straight Treasuries, and significantly more yield, maybe even 10% more yield. It's our view that it's likely that the economy is slowing and possibly entering a recession. So if that does happen, normally long bonds or interest rates will either stay steady, stay in a range, or possibly even go down. And either way in that situation, that would be good for TLTW. If rates just stay where they are, we keep earning the straight bond yield and the option premiums. If interest rates actually go down because we do enter a recession, then we'll get value going up, we'll get the bond yield, and we'll also get the call option yield. And then, lastly, when we would look to trim this is if interest rates go down a lot. So right now we're getting 3.8% on the bond yield themselves. But if we do see a scenario where yields come in and now we're only getting 2 or 2.5%, that means we're getting less return, more risk. We would look to trim or sell at that point. And that's it. If you have any questions on the strategy or anything else, feel free to contact myself. My email is right there, or anybody else on your Trap-Hagen team, your advisor. And thanks for listening. Hope all is well and enjoy the spring. Bye-bye.